Hey, this is a behind the scenes look at the mortgage backed security market. And when we're doing rate updates and we're really kind of talking about the market moving and how the bond prices are looking today, this is kind of what we're looking at and want to really kind of show y'all what we see and what kind of help kind of goes into us making decisions on whether we should lock, we should float rates, all that kind of good stuff. What we're seeing here is a website called MBS Live. That's what a lot of us in the industry use. There's a few of them out there, but a lot of us use this site to watch mortgage-backed security pricing in real time. And the as a lot of you have probably heard, when mortgage-backed security pricing goes up, when the bonds go up, interest rates actually go down. So it's an inverse relationship. And until you really kind of see the actual trading of the mortgage coupons in real time, then you really kind of see why it is like that. Basically, how it works is like we're just buying and selling a product just like anything else, anything that you would buy. You go to the grocery store, you get one milk over another, you get one type of orange juice over another, whatever it is, right? So the even though it's not really tangible, it is still a commodity, if you will, right? Like they're still buying and selling money is basically what they're doing. Now, when we're talking about the cost of bonds going up, meaning rates go down, and inversely, the what we're actually doing here is the here on my screen we have conventional mortgage-backed securities, and we also have government mortgage-backed securities, so VA and FHA loans. They're all packaged up. So you would have an entire package of conventional loans with the same type of risk profile and credit profile, all bundled up together. What that does is it allows the banks and the wholesale lenders to stay liquid or reliquidate more quickly, if you will, right? So you package all these up, and before you'd have to wait for loans to get paid off or paid down before you can lend again. Uh, the way things have changed over the last several decades is, you have the same underwriting standards. So Fannie Mae, Freddie Mac, you have VA loans underwritten to the VA handbook as well as FHA for the same. So you have, no matter what lender you fund your loan through, if it is underwritten as a VA loan with a certain credit profile, then you would expect it to be a similar risk. And so you've packaged up all these loans together, and you're defraying the risk amongst all of the loans, and then the investors can buy, a bulk of them too, because a lot of the investors in mortgage-backed securities are big hedge funds, it's mutual funds and whatnot. So you have pensions and all kinds of different larger scale investments, packaging in and buying like $10 million worth of conventional mortgage-backed securities, right? So that's how they work. But also too, it deflates the risk for the investors as well. Like if they said, like hypothetically, if there's like a 5% default rate, then if 20 banks give 20 loans, but 100% of the risk is on each individual bank, then one out of 20 of those loans is going to default. And so one of those loans is going to go bad. Whereas if these banks bundle all 20 of those loans together and sell it as one product, then then all the banks know chance of there's a 5% loss that they can pretty much guarantee instead of one of them losing everything. So it helps mitigate risk for the banks, which allows us to fund more loans. And that's at the end of the day what we want. We want to be able to fund a loan, get it off our books, and then go on to the next one, and it kind of keeps it moving. It's much easier for all parties, really, the consumer as well. But here's what we look at. So you literally purchasing like a 5.5% or a 6% rate a coupon that's a 6% rate off of the open market. Now everyone has a markup, right? every product that you sell in the open market has a markup. That's how you stay in business, how you have profit, right? So basically what we're talking about is you're trading the investors are offering a 6% coupon, the lenders are then purchasing those, marking it up, and then so if you get y- your the final rate has to be within less than 1.25% of that actual coupon. So a 6% coupon, the max rate you could get on your loan is a 7.125. So it has to be within that range as well. So if you have a 7.125% rate on your mortgage, you know, most likely the investor purchased a 6% coupon from the open market and then, giving you a 7.125% rate. And then there's a profit margin in there uh, for the originator, for the bank that actually, funded that loan. Um, and so the costs of those, and as these costs go up, so 100.00 would be a par rate, no cost, no credit, right? Doesn't cost you anything to purchase that. So they do that. It's easier to say, oh, this 6% coupon is coming at a cost of 98.8. It's easier to say that than minus 1.2, right? Um, it allows for us not to get confused if something costs 101 and not plus one or minus one, right? So that's how they do it. And as the cost of these bonds go up, then the like actually the cost of these bonds go down, right? So the cost of these bonds are going down, so interest rates are going up because as as it like pretty soon this 5.5% coupon is going to fall off the board because it's costing too much, right? The price of this has gone down to 96.84. It's just a unreachable cost unless you want to buy the rate down so much that you want to get that rate. And so as this cost continues to go down, what's going to happen is you're not within range anymore. So then the conventional 7.0 coupon is going to pop in there, and so you're going to start buying 7% coupons on the open market to then deliver a 7.5 or 8% rate to clients. So that's why it's an inverse relationship. It's literally the cost uh, of these commodities, really these monetary commodities that you're purchasing and flipping back over to the consumer. So as mortgage bond prices go up, rates go down, and inversely. So right now we're in a cycle of mortgage backed security pricing going down, which is causing our interest rates to go up. So this right here is just the last 5 days that I'm looking at, right? So, but if we scroll back out, like let's take a look at the last 3 months. Now we're really seeing that trend there of the last 3 months of this is the conventional right here. You can see the conventional 6% coupon where the trend is a downward slope on the cost of these mortgage bonds, which means our interest rates are steadily going up right now. Um, and you can see here, I like this view too. A lot of people use the candlesticks. I prefer this view is just easier. It's just cleaner for me to really see. I just prefer that view. You can look at the candlesticks, which shows the low and the high trading of each day, and if it closed higher or lower. It's just I just like this view personally for myself better. But what we look at, this red line is the 25-day moving average, so it's a little more reactionary. You can see how it has bigger swings because it's only taking into account the last 25 days of data. But then the 100-day moving average is what we really want to see, how it's kind of still trending downwards. We want that to start to trend back up so that rates would come down. But as you can see over the last 3 months, now if we do the last year, you can see how the swings that we've had. And like, let's say this right here, November 10th, that's the day before Veterans Day. We had a tremendous spike in the cost of mortgage bonds. So we had rates come down quite a bit, like 3/4 of a point in one day. And, and then of course, over the winter, it we got a little bit better, and then it's just been a slow, steady downward trend in the cost of these bonds, right? So, spikes up and down, but as a whole, you can see that purple line is still very slowly trending downward since the winter. So, that's really kind of what we're looking at on a day-to-day basis, and if we're looking historically as to to what we really kind of think, and that on making decisions for our clients, um, in the short term, right? So we go back to the 5 day averages, and as you can see that we've had a drop in mortgage backed security pricing over the last 5 days. So um, inflation data was not good last week, and when just like any good or service, if inflation goes up, then um, it causes the cost of our product to go up as well. I mean, we're not immune to that. And so we've seen that. Hopefully inflation gets under control and we see this start coming back the other way. But in from day to day, this is kind of what we're looking at to see if locking now or if floating the rate down is better or worse for our clients. So that's kind of what we're looking at. We'll get into this quite a bit more, but this is just a really brief kind of look in on how we see the mortgage market as it's moving.